Today, I'm pleased to welcome Patrick McMillan. Patrick leads the transaction advisory practice at Amplio, where he brings extensive CFO and transaction advisory experience, specializing in quality of earnings, financial due diligence, and helping leaders prepare for exits and acquisitions. Over his career, Patrick has advised companies across industries, guiding small and mid-sized businesses through the financial and cultural hurdles that often make or break a deal. He is known for combining technical rigor with people first mindset, ensuring both the numbers and the leadership are aligned for success. So, with that, I'd like to welcome Patrick. I appreciate you joining us here today.
William, my pleasure. Thanks for having me.
Yeah, really appreciate it. So, the topic that we've talked about before relates to EBITDA and how important getting your numbers right, particularly when it comes towards the due diligence process. Since you sat in the CFO seat and advised so many different companies through exits and acquisitions, how do you think through the EBITDA or the numbers question when it comes to valuation? And how important is it in making sure you get those adjusted EBITDA numbers right when it comes to building a good case to sell a company?
Yeah, I'm actually going to begin with the end in mind and answer that second part first. How is it important and why? Like it or not, there's so much controversy about EBITDA, but whether you like it or not, it's what companies use, small to medium-sized companies use to value. Whether you're selling to a private equity or raising money with venture capital, and there again, venture capital sometimes and sometimes not will use it, but a lot of them will. Or any type, even a banking transaction, just raising debt, they're all going to look at your EBITDA. So why is it important? It's the level playing field that the companies look at. The industry that a company is in establishes the range of multiples that a firm is in. For example, I'm not going to cover a specific industry. Let's just assume it's a 4 to 8x EBITDA multiple. Where your company falls within that range really is determined by what is your company doing? How high or low quality are those earnings? For example, where do the revenues come from? How strong are those contracts with those clients? What's the customer concentration? And then even on the other side, what about vendors and vendor contracts? And are those transferable to a new owner? What kind of contracts are those? Are prices locked in long term? Things like that. And now let's even go into OpEx. Now use employees as an example. Let's say you have 3 key employees. Do you have good, solid, not just verbal relationships, but even contracts with those employees? The stronger that you have things like that in place, then the higher your multiple in that range will go into. And it's not just all about the income statement either, William. It's also about the balance sheet. What are your capital opportunities with customers? How much can you expand with customers? How are you funding the company? Are you accounting for things appropriately? For example, construction industry, do you have over and under billings on the balance sheet, or even in SaaS, do you have deferred revenue, things like that. And so it's really, those things are extremely important when you're looking at valuing a company. It's not to say that if you're not doing any of that, then your company doesn't have any value. But the more solid that you have things in place, and really the best in class companies are going to be in that top range. Well, you have to do everything that's solid to be best in class to get that top valuation. So when I go in and I'm looking at EBITDA, I'm looking at quality of earnings, those are a lot of the analysis of what I'm doing. It's not just about the numbers. It's not just saying, okay, well, let's add back X, Y, and Z. Let's add back personal expenses. Let's add back non-operating. Yeah, that's part of it. That's the science behind where you actually have some fixed numbers in there. But the art that's behind it is truly understanding the firm, the owners, the company, the customers, everybody involved, upline and downline, trying to figure out, well, really what determines a good quality asset? It's all about risk. How are you de-risking the company as a seller so that a buyer can also have reduced risk? And when that asset, that company is transferred to them, the more risk you have, then the lower valuation you're going to get. And so you really are trying to de-risk that, not just for a buyer, but let's even say for yourself, because the better you do that, then the better you're going to run the company as long as you have it anyway.
Yeah, if I could touch on that, because that's something that I hear a lot is the quality of earnings is about valuations. It's about exiting. But I think what you're touching on is a theme that I think a lot of owners are missing or founders that are thinking about it is actually just having good quality of earning practices is just going to make you a better company. And so can you talk a little bit about the difference between the mindset of, okay, I got to do this stuff when I'm selling, when I'm preparing it for sale, versus these are just the good things to be doing all along because they're just going to make me a stronger company and more successful.
I'll give you a real example of a company I was involved in a handful of years ago. And we hear a lot about, probably not so much today, but we used to hear quite a bit about that corporate veil. And what that means is make sure that you're keeping your personal stuff separated from your business stuff. Now, let's be honest, not many people do that, especially when you're a small to medium sized business. You're going to swipe your business card when you buy dinner a lot of times. You're going to use your business account when you're booking that trip to Hawaii or Fiji because you want to reduce your taxes. But the thing is the more you do that, not only you're putting the company at risk, but also it's almost like a mind shift change. Now you're using a company for your personal piggy bank. So this company that I was involved in several years ago, they were doing that quite a bit. It was a decent sized company. But what happened is they, the owners, and their CPA were not communicating about what was what. The CPA was thinking, oh my gosh, all of these expenses are personal expenses, and so I'm going to book them as shareholder distributions. Well, that hits the equity section on the balance sheet, doesn't hit the income statement. So that does two things. Number one, it actually increases your earnings or your net income, which increases your taxes. But here's the thing, when I dug in on a quality of earnings, I was able to look at a lot of those and I identified over a 3-year period about $900,000 of business expenses, legit business expenses. I'm talking about business travel for clients. I'm talking about business meals, things like that, that were booked to distributions, but I had to move those. I moved them over onto expenses in the income statement. Now, what did that do? Yes, it reduced the earnings. And people listening probably saying, well, Patrick, oh my gosh, that reduces the multiple. Well, reduces the earnings, reduces the valuation. But here's what it does. It actually normalizes what the earnings, you're looking at what the true economics of the company are. Number one, you really have to make sure that that company, the numbers that you're looking at are the true economics, that they reflect what the company is really doing, number one. Number two, yes, it reduced the earnings, but that also in turn reduced what taxes they should have paid. So we went back and refiled tax returns. So I was able to pay for myself and a lot more after that. So it really helped. And we got the company to where it really was reflective. So the buyer that came in, it was a private equity group, the buyer that came in saw, yes, they saw the reduced earnings, but they saw that things were accurate. And that made a world of difference, for them to be able to gain trust. And what we were doing, we actually became their fractional CFO for years after that. So they brought us in to really help make sure that there was a continuity of that. That's why those things are important, to be able to say, hey, you know what? Earnings may be this, but let's make the adjustments to really, truly reflect what they are, not just for you as the owner, but for anybody that's going to operate this business.
So it sounds like, because this is something else that someone shared with me, is that you should always have your company prepared to sell, even if you're not thinking
Yes.
about selling. So that seems to
Yeah.
be in line with that theme.
Yeah. And thank you for bringing us back to your original question. Being exit ready or prepared to sell is just good business in general. Because as you're doing those things to prepare for what an outside perspective would look like, then really you're just making your business more solid. Again, you're reducing risk, not just for a buyer, but for yourself. And as you do that, then inherently your business is going to become more solid and probably even grow, whether it's revenue and or earnings or both. And let's face it, that's why you're in business, right? You need to make money. It's probably something you are enjoying. I hope so.
Yeah. And again, I think it's that quality of earnings and also making sure, at least from what I'm hearing from you, it doesn't matter the type of company or the size of the company. You don't want to treat your company like it's a lifestyle business. It's just
Right.
not, you need to treat it like it's a business. And that starts with the books.
Exactly. To kind of bridge that gap between, well, but I want to reduce my taxes. And so I'm going to use it for a personal piggy bank. But the thing is when you do prepare to sell and someone comes in and does a quality of earnings, the more adjustments that have to be made, the lower the quality is. And so if you start that practice now, make that separation, don't use it for your personal piggy bank, then you're actually automatically by default increasing the quality right there.
And increasing the quality of earnings gets back to that multiple. So I think that's the other thing that people, if I'm doing my math right, you may reduce, let's say you're $1 million business and you may reduce it 200,000. So it's only reflecting 800,000 in earnings. But if your quality of earnings is greater and you're going from 3x multiple to a 4x multiple, your net on that actually turns out to be you're making a significantly more money when you take into consider the exit.
Exactly. When you look at an average, let's just say a multiple is going to be 4x, then in your example, that $200,000 times 4, that's automatically 800 grand more in purchase price.
Yeah. And so that makes a big difference in all of that. No, I appreciate that. That's all really, really good insight about making sure that you run your business with strong quality of earnings from the very beginning, because it's just going to give you that extra 1 or 2 times X, which makes a big difference when you're exiting.
And William, if you don't mind, I want to add a point here.
For sure.
You can get a quality of earnings at any time. It's not just for transactions. I have done a lot of sell side quality of earnings just to help a company see where they're at. My valuation company that we use will do valuations every year on many companies because they want to see how everything that they're doing actually helps create better value. And a quality of earnings will help you do that. I will do a list of, hey, here's some recommendations I can set up for you so that you can have a better quality of earnings next time you do one.
And that's, I think, again, it just sounds like the cleaner the books, the stronger the quality of earnings, the greater the multiple. And that's really what you're after. So you can't start too early is also what I'm hearing.
Very
Because that's, I think,
yes.
also what the wealth managers and the CEPAs are all about too, is just get ready to sell even when you're not thinking about selling. So that way you just have a strong book of business.
Yeah, you nailed it right there.
Awesome. Well, thank you so much for those insights. I really appreciate it. Again, thank you so much for your time, and would love to stay connected and keep having these conversations with you.
Let's do. Please do. I'm excited to hear more about your research and how it goes. And yeah, when you publish it, I'd love to read it.
All right, will do. I will definitely share all of that good stuff.
Nice. Sounds good. Thanks, man.
Thank you.